Help capture the history of our markets by contributing to the John Lothian News GoFundMe campaign to support the MarketsWiki Education history-focused video series and more.
From Barchart.com, which serves over 2 million users per month, to market data and technology solutions for commodity, financial, and media businesses, Barchart connects you to the markets.
Barchart got started as an outgrowth of a company called Logical Systems, which was a single-person proprietorship, and we produced a piece of software for traders in the futures pits back in the late 80s and early 90s. Then when the internet came around, Barchart, or the founder's nephew, came over from Scotland, and the founder and his nephew decided to put the software that was on the desktop onto the internet. And that's how Barchart was born. One of its first customers was the Mid-American Commodities Exchange, or the MidAm. And then we grew our customer base from there to the CBOT, to the CME, Minneapolis, the New York Board of Trade, Winnipeg, Kansas City. And so Barchart in the early days of the internet was the primary provider of quotes and charts on the exchanges' websites themselves. So when the CME first launched their E-mini contract, it was critical for them to get that data out to the customer base, and a lot of people didn't have access to the quote terminals. So Barchart provided, through the auspices of the CME, real-time S&P E-mini quotes, and then similarly, when the CBOT launched the mini Dow, Barchart not only provided real-time Dow trades and bids and asks, but also full market depth. I think that might have been the first time full market depth was provided for free by one of the futures exchanges. History has shown that the S&P 500, the mini contract, was a very successful launch for the CME, and the mini Dow was a pretty successful launch for the CBOT. They eclipsed in volume. They eclipsed their big cousins pretty quickly, and it was critical that the data was available to the public so that the people could trade these contracts and know where the prices were. Well, back then, Java applets were the first and pretty much only call it multimedia experience that you could have. Flash was just beginning. And one of the problems with Java was that, this is getting kind of esoteric, but Symantec was the creator of the virtual machine that sat on Netscape, if we remember that one. And Microsoft had their Internet Explorer. They had their own Java virtual machine, but they really weren't super compatible with each other, and they had some certain idiosyncrasies. So at the beginning, just as a fast way of getting to market, we would just use a fast repeating web page that would flash and essentially refresh quotes as quickly as possible. And I think we had it at a 5-second refresh. Then later on, we were able to, when the technology started to stabilize, we were able to offer applets for users in the IE and Netscape browsers. So Microsoft at the time was pushing a technology called ActiveX, which came out of the Windows 95, 98 realm and really started to see itself with Windows XP. And Internet Explorer allowed for you to write actual code that was machine code that was then embedded and triggered by the web browser. And so we spent a fair amount in especially things like streaming charts that need actual real code. And so we did our streaming charts and quote boards in ActiveX embedded into the web pages. And that allowed us to have both a desktop application and a web-enabled application at the time. ActiveX later on was phased out, largely due to security concerns. One of the problems with ActiveX components is that you can actually have deployed software on the machine itself, and a lot of malicious software was written that way. And so Internet Explorer eventually phased it out. In the 2011, 2012 space, it became apparent to the folks in the internet community that there was a need for a streaming protocol to the browser. At the time, there was a hodgepodge of something called Ajax, which allowed a web browser to make an off-band request to an XML document. And then people were using Flash, and then there was a technology called Socket.io. And all of these kind of led everyone to realize that if you really want to make updates to the browser, and the browser became the more of a deployed platform as a thicker and thicker client, became apparent that there needed to be a streaming protocol. For instance, when you get updates in Twitter, or when you get updates in one of your other applications or browsers, those updates are coming in on as a stream. And so WebSockets became the idea that was around, like I said, 2011, 2012. It really didn't become formalized and adopted across browsers until a few years later. And right at the beginning of the time when it was gaining adoption was when we decided to convert our streaming data servers to a WebSocket platform so that we could push the content straight to the web browser itself. Barchart became an early adopter of the cloud, Amazon specifically, already in 2009. There are a couple of driving factors for it. One of them, and probably the primary one, was the concept of burstable bandwidth. So at the time, we were delivering real-time data directly from our data centers, and we needed to have sufficient bandwidth to cover two extreme peaks of data. And the pattern actually hasn't changed. The amount of data that kicks in right at 8:30 Chicago time in the morning and lasts a good half hour. And then at the end of the day, there's also a solid half hour of peak. It's not that the traffic is 2 times or 3 times, it's orders of magnitudes larger in these small peaks of time. And in order to cover all of and be able to handle all of our customers, we had to, at the time, purchase enough bandwidth for those 2 peaks of time. And then we had all of this extra time throughout the rest of the day where we really weren't using the bandwidth. And the one nice thing about the cloud, especially a large carrier like Amazon, is these guys have, hundreds and thousands of gigabits worth of traffic that they can support. And so that allowed us to smooth the costs at a much better rate than what we were able to do when we had to provide direct connects, or not direct connects, but provide enough bandwidth for each of our customers directly from our data centers. The traditional web server model is that you have a website and it's got content on it. And if you're providing services, then there's a web server that hosts your APIs or hosts your content. And these are run on Apache or Nginx or something like that. And most of the content that we're providing now, everything is serverless. So we are using Amazon Lambda, which is the concept is that you have a function, and the function is triggered when there's some call to it, either through an API gateway. So we allow someone else to actually host the web server, if you want to call it that. And we only respond to singular requests. And that allows something, for instance, on the Amazon platform, you can spin up tens of thousands of simultaneous requests instantaneously, because you don't actually have to worry about spinning up the servers. That's already done for you. So this is sort of the next extreme level from, you have the concept of virtual machine, then you have the concept of, auto scaling these machines, and then you completely forget about the machine altogether, and you just have an upload, essentially code snippets that respond to a very specific task. Same thing on the database side. So you could manage your own database systems if you want. For instance, you could have your own database server, or you could have Amazon manage a database server for you, or you could use something like Dynamo, which is it's just a service. You make an API call to get data, and data arrives, and you don't care about what's happening in the back end, and theoretically the back end is infinitely scalable. Barchart, the website, so barchart.com, is the largest futures-centric portal on the internet. We have over 2 million unique monthly visitors. We have, last time I looked, I think it was 50, 60 million page views. It's probably higher than that at this point. And we have quite a large amount of reach in terms of geography, not just North America, but global. And so we provide not just North American markets, we provide Eurex, we provide Euronext Life stuff, we provide Asian data. And so we really are a global provider of commodities data on the internet. What we've seen recently, a growth in appetite for what I guess you could call alternative data, or what I would say would be non-exchange data sets. So things outside of the realm of market data. Most notably, the OTC markets. Barchart has one of the largest coverages of North American cash grain, corn, wheat, soybean, and other data. That's due to a large part because we've built a network of grain elevators and consumers and direct buyers of North American grain. We also have weather data. We also have crop production data. And we are recently beginning to use forecasting and AI models to produce crop production yield estimates. It's interesting. So it depended on the market. There were some that were clearly coexisted very nicely side by side. I would say that the Eurodollars and the large S&P 500 contracts really had both the Globex quotes and then the open outcry quotes were intermingled, intertwined. You would see a fair number of both throughout the day. But then you saw other markets that really flipped fast. For instance, a good example, I think, was the Treasury complex, especially the 10-year notes. I remember watching the data, and you would have, reasonably sized lots here and there kick in. The moment that they went electronic, clearly there was a demand, and I think it was sort of the speed of execution that was the driving factor there, but clearly there was a demand by financial institutions for that to go electronic. And you started seeing trade sizes not, 2 or 5 or 7 lots at a time, but you started seeing 70 lots and, contract size is much larger, volumes much larger. Because it was electronic. That, of course, begets more data. And the more data you have, then the more stress you have on the systems. And then as you have more stress on the systems, you build those pipes out, you build those systems out, and then that allows for more volume to come through. And you sort of see that, I think, not just internally, but you also see that as a global thing, that the more bandwidth you give something, it gets consumed, and then as it gets consumed, it begets more bandwidth and it begets more volume. We had the 14 4s and the 56Ks, and then you had these breakout cables that you could, have multiple different serial ports connecting to. And when an exchange is limited to 19.2 kilobits, then, there's only so much traffic you can push through. But I think a good example is when you allow people to have access to or closer access to trading gateways. Something as simple as auto quoting starts to really drive up quote volume, right? And so that wasn't possible when you had really small bandwidth connectivity. And so you were basically just transferring, some trades, some quotes. And as the volumes grew, the demand grew to grow these pipes out. As the pipes grew bigger, people were able to do more and more with that data. They were able to close the markets. They were able to sort of close the spreads on the markets. And so you can do that with electronic systems. I think that there's sort of an extreme. You sort of see that in the equity options space where singular moves in underpinning price on an equity suddenly trigger a massive flow of volume in quote messages, all because of the algorithms that are pushing those quotes out there. There's obviously issues with that. A computer can generate an infinite amount of garbage if you let it. So that's the issue there. But again, as people and as more and more people were able to get into the markets became more liquid, and as they became more liquid, obviously the volume grew, and both on the quote side and the trade side. We've got a few different things that we're working on. We're really the last few years concentrating sort of in the I don't want to call it a core commodity component, but we really are concentrating on a lot of stuff in the agricultural markets and in the food sector. We recently launched something called the Commodity Price Network, where we are inviting, again, going back to alternative data or third-party data services to participate in our network. And so recently we added Oil Market Journal, we added Mercaris, we've added the Pan Exchange. And so you're seeing a lot of new, maybe not as mainstream contracts being quoted on this. You're seeing a lot of, again, OTC markets, cash markets, things that are a little bit more esoteric, but have very high value to a certain group of people that are within those markets. The storage at the moment, it's the transfer and extract that actually becomes strangely problematic. And when you start getting data sets that are terabytes and terabytes in size, and then, or petabytes in some cases, and then someone says, well, can I get this data? You realize that it will, at best bandwidth, it's going to take you 3 days or a month or some real amount of time to actually transfer the data from point A to point B. And so you look for ways of sort of managing that type of data in terms of scale and size. Amazon has services like Glacier that are these long-term data stores of mass quantity data that you might not be accessing on a regular basis, but that you need from time and time again.
John Lothian News would like to thank those individuals who have contributed to our MarketsWiki Education GoFundMe campaign. Their financial assistance allows us to produce and distribute videos like this for our Open Outcry Traders History Project or the Path to Electronic Trading video series. Join them in supporting John Lothian News, capturing the history of our industry.